$4,888 per ounce. That's where gold peaked on Tuesday, January 21st, 2026, the highest price gold has ever reached in human history. Silver hit $95.84, and then, 72 hours later, after Trump cancels the tariffs that caused the panic, gold crashes to $47.81. Silver dumps to $91. The Nasdaq erased every single gain from 2026. The S&P 500 officially turned red, $1.4 trillion wiped from U.S. stock market value in a single day. But here's what they're not telling you on the news. When you add up the stock market crash, the gold and silver spike and dump, the bond market chaos, the crypto collapse, analysts estimate the total wealth that changed hands across all global markets in 72 hours was approximately $5 trillion. $5 trillion. And while retail investors were bleeding, while everyday people were watching their savings evaporate, institutional players with better information and positioning captured the other side of those trades. This wasn't random volatility. The timing, the sequence, the reversal speed, all of it raises serious questions about how markets actually function. And I'm going to walk you through exactly what happened in the next 25 minutes with data, charts, and a timeline that will fundamentally change how you see financial markets. Welcome to the hidden economy. I expose patterns in markets that mainstream media either misses or chooses not to discuss. If you want to understand how wealth actually moves in modern financial systems, hit that subscribe button and turn on notifications. Because what I'm about to show you matters whether you trade or not. Let me start with the complete timeline. Because when you see all the pieces together, the coordination becomes difficult to dismiss as coincidence. Friday, January 17th, 2026. Markets close for the weekend. Everything seems relatively normal. Gold trading around 4,600, silver around 87, S&P holding year-to-date gains, Bitcoin above 90,000. Retail investors going into the weekend with no particular alarm. Saturday and Sunday, markets are closed, no trading, no price discovery, just news. And over this weekend, a significant announcement drops. The Trump administration threatens to impose 10 to 25% tariffs on European allies. Not China, not adversaries, our closest partners, France, Germany, the United Kingdom. The stated reason? To force a deal on Greenland and other geopolitical issues. Now, consider the psychology of this timing. You're a retail investor. You just heard that the United States might start a trade war with Europe. Markets are closed. You can't do anything. You can't sell. You can't buy. You can't adjust your positions. All you can do is read articles, watch news, and absorb fear for 48 hours straight. Financial media amplifies the concerns. Analysts discuss worst-case scenarios. Comparisons to previous trade wars emerge. This is maximum uncertainty cultivation when people have no ability to act. Tuesday, January 21st. Markets finally open, and the reaction is severe. The S&P 500 drops substantially. $1.4 trillion in market capitalization disappears. The Nasdaq, which had been positive for 2026, goes negative. All year-to-date gains erased in hours. Bitcoin collapses from over 90,000 to below 87,000. Roughly 10% decline. Crypto markets decline across the board. Tech stocks down. Financial stocks down. This represents panic. Retail investors watching portfolios decline and making emotional decisions. No margin calls trigger. Stop losses execute. Algorithmic selling accelerates the decline. It's a cascading liquidation event. And where does capital flow? Directly into gold and silver. Gold surges from $4,600 to $4,888. A $288 move, nearly 7% in a single day. The highest price gold has traded in recorded history. Silver jumps from $87 to $95.84, a $9 spike, over 10%. These are extraordinary moves for precious metals markets. Volume is notably elevated, among the highest trading volume in gold and silver in over a year. That volume profile suggests retail participation, people watching their stock portfolios decline and seeking perceived safe havens, fear-driving decisions rather than valuation analysis. But here's the critical question that deserves examination. Who's selling gold at $48.88 and silver at $95.84? Who's providing liquidity on the other side of that panic buying? Based on historical trading patterns and market structure, institutional players with larger positions are typically the counterparties in these scenarios, the same players who've been documented accumulating precious metals during quieter periods at lower prices. They're systematically providing liquidity to panicking retail buyers at peak prices. Meanwhile, something else is occurring that receives minimal attention. Japan's bond market experiences extreme volatility. Over the past 2 days, Japanese 10-year government bonds show a 6 standard deviation move. In statistical terms, such events are exceptionally rare under normal market conditions. This suggests systemic stress beyond just US-European trade concerns. Japanese bonds experiencing this level of volatility signals global bond market instability. It indicates risks spreading across interconnected markets. And that systemic uncertainty is what drives gold to 48.88. But here's where the sequence becomes difficult to explain through conventional policy analysis. Wednesday, January 22nd. Less than 24 hours after markets experienced severe dislocation, less than 1 day after gold hit 48.88 and silver hit 95.84. Trump makes an announcement. The tariffs are canceled. Security framework has been reached with European allies. Crisis resolved. Trade war averted. And immediately, gold reverses from 48.88 to 47.81, $107 down in hours. Silver drops from 95.84 to 91, nearly $5 gone, roughly 5% decline in minutes. Retail investors who bought at peak prices are now holding positions with immediate losses. If you bought gold at 48.88, you're down over $100 per ounce. If you bought silver at 95.84, you're down nearly $5. That represents thousands of dollars per futures contract or significant percentage losses on physical purchases and ETF holdings. Additionally, the Supreme Court announces it will make a ruling on President Trump's use of tariff authority. This ruling could reshape U.S. trade policy, shift inflation expectations, and alter market dynamics. So let me pose a straightforward question. Does this timeline suggest conventional policy development? Trump threatens substantial tariffs on European allies over a weekend. No apparent prior warning, no visible policy groundwork. A sudden threat when markets are closed, creating maximum uncertainty with no ability for price discovery. Markets opened Tuesday and experienced severe dislocation. $1.4 trillion removed from stock values. Gold and silver spiked to historical highs. Bonds experiencing volatility globally. Substantial market stress. Then Wednesday morning, less than 24 hours later, Trump reverses the policy. Security framework reached. No detailed explanation provided. No clarification of what was negotiated. No joint statement from European leaders. Just crisis resolved, tariffs canceled, situation normalized. And now the Supreme Court will rule on whether Trump has the authority to implement what he just announced and canceled. Does that sequence align with how international trade policy typically develops? Or does it more closely resemble a catalyst designed to move markets in a specific direction? Let me provide my analytical framework, because I've studied financial markets and policy interactions for years, and this sequence stands out as unusual. This appears consistent with a coordinated market operation rather than organic policy development. Multiple factors support this assessment. First, the timing. Announcing tariffs over a weekend when markets are closed has no policy advantage. Standard practice for major announcements occurs during market hours or after close on weekdays, so markets can react, and officials can provide clarification if needed. Weekend announcements maximize uncertainty without any outlet for price discovery. That timing appears designed for psychological impact rather than policy communication. Second, the target selection. Using tariffs against European allies for leverage makes limited strategic sense. If tariff policy serves strategic purposes, typical targets include countries where leverage exists or adversaries requiring pressure. But France, Germany, United Kingdom, our NATO partners, our most stable trade relationships, the geopolitical logic is unclear, unless the objective isn't geopolitics, unless the objective relates to market movement rather than policy outcomes. Third, the magnitude. 10 to 25% tariffs represents an extreme position. That's not negotiating leverage, that's maximum threat level. That magnitude appears calibrated to create maximum market reaction. Fourth, the reversal speed. 24 hours. Genuine international negotiations require weeks or months. Trade agreements require years. Security frameworks require sustained diplomatic engagement. But this situation resolved in one business day, with no details, no explanation of terms, no press conference, no joint statement from European leaders confirming any agreement? That's inconsistent with how diplomacy functions. That's inconsistent with how policy develops. That timing is consistent with market catalyst creation and removal. Fifth, the Supreme Court dimension. If the Supreme Court is preparing to rule on whether Trump possesses this authority, why deploy it now? Why create a substantial market event using questionable legal authority that requires immediate cancellation? Unless the cancellation was anticipated from the beginning. Unless the objective was never sustained policy. Unless the objective was the market movement itself. And sixth, examining beneficiaries. Who captured value from this 72-hour sequence? Not retail investors. They sold stocks during Tuesday's decline. They bought gold and silver at peak prices. They experienced losses on both sides of the trade. Not European allies. They faced uncertainty and market instability without clear reason. Not American businesses. $1.4 trillion in stock market value disappeared, affecting retirement accounts and investment portfolios. Not American consumers. If tariffs had been implemented, prices would have increased. The entities that benefited are those positioned correctly ahead of the moves. Those who sold stocks before the decline. Those who sold gold and silver at peaks to panicking retail buyers. Those who bought back stocks after the decline at lower prices. Those who repositioned in precious metals at reduced levels after retail participants were shaken out. This wealth transfer follows a historical pattern documented across decades of market analysis. Let me explain the apparent mechanics of how operations like this function, because understanding the mechanism matters. Step 1. Accumulation. Over extended periods, major institutions build positions quietly. They accumulate physical gold and silver during price consolidation periods. They accumulate stocks during corrections. They position strategically over time. Analysis of COMEX vault data suggests JP Morgan has accumulated an estimated 600 million to 1 billion ounces of physical silver over the past decade. That estimation comes from tracking withdrawal patterns and vault inventory changes. Step 2. Pre-positioning. Institutions with information advantages, whether through relationships with policymakers or superior understanding of market patterns, position ahead of catalysts. They reduce equity exposure on Friday or establish short positions. They hold precious metals, positions awaiting the anticipated spike. They position based on pattern recognition. Step 3. The catalyst. Weekend tariff threat on European allies. Time for psychological impact. Markets closed, so uncertainty builds without outlet for action. Financial media amplifies concerns. Retail investors process fear for 48 hours. Step 4. The reaction. Markets open Tuesday. Retail participants sell stocks emotionally, triggering algorithmic selling and cascading liquidations. 1.4 trillion removed. Simultaneously, retail participants buy gold and silver seeking safety. Volume expands. Institutions provide liquidity on the other side, systematically distributing their holdings at 48.88 gold and 95.84 silver. They're selling into elevated demand at peak prices. Step 5. The reversal. Wednesday morning, tariffs canceled. Crisis resolved, markets stabilize, but prices don't return to pre-crisis levels. Stocks remain significantly lower. Gold and silver decline sharply from their peaks. Retail participants who bought tops now hold underwater positions. Retail participants who sold stocks at lows missed recovery. Maximum adverse outcomes for retail on both directions. Step 6. Repositioning. Institutions now acquire stocks at lower prices than they sold. They reaccumulate gold and silver at lower prices than they distributed. They've captured both sides of the movement. They've profited from both the elevation and the decline. Retail participants funded the entire operation. This represents sophisticated execution. This represents coordination at some level. This doesn't require conspiracy theories involving secret meetings. This requires institutions with information advantages and understanding of market psychology, executing a playbook refined over decades. Let me quantify the wealth transfer, because the scale matters for understanding market structure. $1.4 trillion removed from U.S. stock market capitalization on Tuesday. That's the reported figure. The NASDAQ and S&P 500 both erased all 2026 gains. $1.4 trillion in stock value gone. That affects retirement accounts, 401k plans, pension funds, retail brokerage accounts. Real wealth disappeared, but that's only stocks. That's not the complete picture. Gold moved from $4,600 to $48.88, a $288 change. The global gold market represents approximately $15 trillion in total above-ground gold value. A roughly 6% move in gold prices represents about $900 billion in total gold market value change. But the derivatives market is substantially larger. Gold futures, options, ETFs, leveraged products. The notional value of gold derivatives is estimated at over $100 trillion. Even a small fraction changing hands represents hundreds of billions. Silver moved from 87 to 95.84. That's over a 10% increase. The global silver market is estimated at roughly $1 trillion when including physical and paper markets combined. A 10% move represents $100 billion in value change, though with leverage and derivatives, actual capital flows are larger. Then crypto. Bitcoin declined from over 90,000 to below 87,000, over 3%. Bitcoin's market capitalization alone is approximately 1.8 trillion, representing over 50 billion just in Bitcoin. Adding Ethereum and other major cryptocurrencies suggests another 50 to 100 billion in crypto market losses. Then bonds. Japan's bond market experienced a 6 standard deviation move in their 10-year government bonds. That volatility level in one of the world's largest bond markets represents hundreds of billions in losses for global bondholders. U.S. Treasuries also moved significantly as investors sought safety, then reversed when the crisis was canceled. Then currencies. The dollar strengthened on the tariff news, then reversed. Currency markets trade over $6 trillion daily. Even small percentage moves in major currency pairs over 72 hours represent tens of billions changing hands. When aggregating across markets, stocks lost 1.4 trillion, gold market moves involved hundreds of billions, silver market moves involved hundreds of billions, crypto declined 100 to 200 billion, bonds experienced hundreds of billions globally, currency fluctuations involved tens of billions, plus all the derivative positions, options, futures, leveraged trades across all these markets. The estimated total amount of wealth that changed hands, that moved from retail investors to institutional players positioned correctly, is approximately $5 trillion over those 72 hours. $5 trillion. That exceeds the annual GDP of most countries. That's more wealth than most nations generate in a year. And it moved in 3 days from the accounts of everyday investors into the accounts of Wall Street institutions and trading desks that understood the pattern. Let me provide historical context, because this exact pattern has appeared repeatedly. The structure remains consistent. Create fear, elevate safe haven prices. Retail panics in, distribute at peaks. Remove fear, crash prices. Retail panic sells, reaccumulate at lows. The mechanism has been deployed for decades because human psychology remains constant. March 2020, COVID pandemic emerges. Markets crash globally. Gold spikes from 1,500 to 2,000. Silver from 12 to nearly 30. Retail floods into precious metals anticipating currency collapse. Then, Federal Reserve announces unlimited quantitative easing. Crisis contained. Gold consolidates sideways. Never breaks out decisively. Silver declines substantially. Institutions distributed at elevated prices to retail. August 2011. European debt crisis. Greece approaching default. Fear of contagion. Gold reaches 1900. Silver 49.50. Maximum retail participation. Then, European Central Bank announces intervention programs. Crisis contained. Gold crashes to 1600. Silver to 26. Retail experienced substantial losses. Institutions profited. October 1987. Black Monday. Stock market crashes 22% in 1 day. Largest percentage decline in history. Retail panic sells everything. Then Federal Reserve announces liquidity provision. Crisis contained, market rebounds. But retail sold the bottom. Institutions bought the decline and captured substantial gains. January 1980. Hunt Brothers attempt to corner silver. Price spikes from $6 to $50. Retail anticipates further gains. Then, COMEX changes margin requirements overnight, forces liquidations. Silver crashes to 10. Hunt Brothers experience bankruptcy. Retail destroyed. Institutions profit. The pattern repeats. Crisis, panic, retail buys tops or sells bottoms. Intervention or catalyst removal, reversal, institutions profit. The script remains consistent. Only the specific crisis changes. The mechanism stays the same. And this week represents perhaps the most precise execution I've documented. The tariff threat, the timing, the reversal, the Supreme Court ruling announcement, the coordination appears too precise for coincidence. Now, let me address the obvious skepticism. This sounds like conspiracy theory. There's no way government and banks would coordinate to manipulate markets. That's illegal. You're correct. It is illegal. And documented cases show it occurs regularly anyway. Let me provide factual precedents, not theories. 2020. JP Morgan fined $920 million for spoofing and manipulating gold and silver markets over 8 years. They admitted guilt. They paid the fine. They continue trading precious metals. The fine represented a fraction of estimated profits from the manipulation. 2012. LIBOR scandal. Multiple major banks rigged the London interbank offered rate, the benchmark interest rate affecting trillions in global loans, mortgages, and derivatives. Banks paid billions in fines. No executives faced criminal charges. 2008. Financial crisis. Banks packaged subprime mortgages into securities. Rating agencies assigned owner-delay ratings, sold to pension funds. Then banks bet against their own products. Global economy collapsed. Banks received government bailouts funded by taxpayers. No executives faced criminal charges. 2014. Foreign exchange manipulation. Multiple banks rigged the $4 trillion per day Forex market. Fined billions collectively. No executives faced criminal charges. 2004 through present. Gold and silver price fixing. Multiple banks fined repeatedly over decades for rigging the London gold fix and silver fix. Activity continues. These aren't conspiracy theories. These are documented, admitted, adjudicated facts. Market manipulation represents standard operating procedure for major institutions. Banks get caught, pay fines smaller than their profits, and continue operating. It's calculated as a cost of business. So, when I suggest this 72-hour sequence across gold, silver, and stocks shows signs of coordination, I'm not speculating wildly. I'm identifying a pattern consistent with decades of documented precedent. The distinction this time is they appear to have used a policy announcement as the catalyst instead of spoofing orders or rigging benchmarks. But the effect remains identical. Retail loses. Institutions win. Wealth transfers from the many to the few. Now, let me explain what likely happens next, because this pattern isn't complete. Institutions just captured hundreds of billions, possibly trillions, from this operation. But they didn't capture that capital to hold cash. They're going to redeploy. Where? Back into the same assets they distributed, but at lower prices. Gold will likely consolidate. I expect settlement in the 4,400 to 4,700 range over coming weeks. That's where institutions will quietly reaccumulate. They distribute at 48, 88. They'll acquire at 4,500. $388 profit per ounce on the round trip. Silver will likely consolidate in the 85 to 90 range. They distributed at 95, 84. They'll acquire at 87. $8 round trip profit. Stocks already recovered slightly from Tuesday's lows, but expect continued volatility. Institutions will use any weakness to accumulate at lower prices than they distributed. And then, in 6 months or a year, there will be another catalyst, another crisis. Perhaps Iran, perhaps China-Taiwan tensions, perhaps a banking crisis, perhaps a debt ceiling confrontation. The specific crisis doesn't matter, the pattern will repeat. Create fear, elevate safe haven prices, retail panics in, institutions distribute. Remove fear, prices decline, institutions reaccumulate. The cycle continues, unless retail investors recognize the pattern and stop participating emotionally. If retail stopped panic buying during manufactured crises, if they stopped panic selling during manufactured crashes, if they held physical precious metals long-term instead of trading paper, if they bought stocks during crashes instead of selling, the pattern wouldn't function effectively. But that requires discipline, education, emotional control, understanding that market structure is designed to exploit fear and greed to separate people from wealth. So what actions protect you? First, stop reacting to headlines emotionally. Not every crisis represents the end of the world. Most crises are temporary, often designed specifically to move markets and create trading opportunities for informed players. When you observe maximum fear and panic, that's usually the time for calm analysis. When you observe complacency and optimism, that's when caution makes sense. Second, if you hold precious metals for long-term wealth preservation, which I support, buy physical and hold long-term. Avoid trading paper contracts. Don't attempt to time every movement. Accumulate during quiet periods and consolidations. Hold through volatility. Physical metal in your possession cannot be manipulated away from you. Third, understand you're participating in markets against institutions with information advantages, more capital, superior tools, and coordination you'll never possess. The only way to avoid being exploited is refusing to play their game. Don't use leverage. Don't trade short-term. Acquire quality assets and hold. Fourth, diversify. Don't concentrate everything in one asset class. Physical gold, physical silver, Bitcoin and self-custody, real estate, productive businesses, spread wealth across assets that can't all be manipulated identically simultaneously. And fifth, most importantly, recognize that what we just witnessed is not a free market in the idealized sense. It's a managed market. It's a structured market designed to extract wealth from the uninformed and transfer it to the informed. The sooner you understand that fundamental reality, the sooner you can stop being victimized by it and start positioning to protect yourself from it. Let me conclude with this observation. What we witnessed over 72 hours from January 18th to 21st, 2026, does not appear to be organic market behavior. It does not appear to be standard policy uncertainty. It does not appear to be unpredictable volatility. The evidence suggests a precisely executed, carefully timed wealth transfer from retail investors to institutional players, 1.4 trillion removed from U.S. federal stocks. But when you aggregate movements in gold, silver, bonds, crypto, and currencies across global markets, analysts estimate the total wealth that changed hands at approximately $5 trillion. $5 trillion. From retail investors to institutional players, using government policy announcements as the apparent catalyst. The pattern suggests they anticipated the tariffs. They anticipated quick cancellation. They positioned perfectly. They distributed stocks before the crash. They distributed gold at 48.88 and silver at 95.84. They reacquired everything at lower prices. And retail funded the entire operation by reacting emotionally instead of strategically. This is the pattern. This is the structure. This is how modern markets appear to extract wealth from the uninformed. But now you understand. You've seen the pattern. You recognize the playbook. You understand the mechanisms they appear to use. So don't allow this to happen to you again. Don't panic buy at tops. Don't panic sell at bottoms. Learn from this week. Adapt. Position strategically. And protect your wealth from a system that appears designed to take it. Thank you for watching The Hidden Economy. If this analysis changed how you see markets, hit that like button. subscribe, and turn on notifications because I'll continue documenting these patterns as they develop in real time. Share this video with everyone you know who trades or invests. They need to see this. They need to understand what just occurred. Leave a comment and tell me, do you think this was coincidence or coordination? Do you trust market structure after seeing this? What are you doing to protect your wealth? Let's discuss. And remember, in markets, truth is often hidden beneath complexity and misdirection. But if you know where to look, you can identify it clearly. Stay informed, stay analytical, stay strategic, and I'll see you in the next one.